When investors think about returns, the natural instinct is to focus on how much money can be made. But what matters just as much, if not more, is how much risk is taken to earn that return. As money managers, that's what we mean by risk adjusted returns. Let's look at this through the lens of real estate versus a diversified basket of carefully selected stocks. With real estate, especially when owning multiple homes or flip properties, returns can look attractive on paper, but those returns often come with concentrated risk. Capital is tied up in a small number of assets, usually in one geographical area. The outcomes depend heavily on factors like local housing markets, interest rates, tenants' behavior, construction cost, and liquidity timing. A single bad project, vacancy, or unexpected repair can materially impact overall returns in that portfolio. There's also the issue of illiquidity. Real estate can't be sold quickly without friction, and so the lack of flexibility increases the risk, even if headline returns appear strong in good years. Now compare that to a basket of stocks that are carefully selected. Equities allow for a broad diversification across industries, business models, and economic drivers. Liquidity is high and costs are transparent, and the risks can be managed through position sizing, rebalancing, and diversification. While stocks can be volatile in the short term, that volatility is often compensated by long-term growth, income, and the ability to actively manage the risk exposure. From a risk-adjusted perspective, the question becomes this: are we being paid appropriately for the risks that we're taking in our portfolio? When portfolios become overly concentrated in property, risk often rises faster than the return. A well-constructed equity portfolio, on the other hand, can deliver competitive returns with less concentration risk, greater flexibility, and clearer risk controls. The goal isn't to choose one over the other blindly. The goal is to allocate capital where the return justifies the risk, not just where the return looks highest in its isolation. That's how we think about building portfolios that are designed to perform across full market cycles, not just during favorable conditions.